So let's go ahead and kick this off. It's been a pretty crazy quarter, to say the least. Love to get your thoughts on what you guys have seen and how we've come to this pretty incredible north of 10% run on the S&P thus far, and it'd also be great just to highlight how you guys saw the year starting, or where you guys were positioned as we began the year.
Yeah, I'll tell you, Carl. Well, it's great to be back with you. And Mary, thanks again for the warm introduction. And, what a timely opportunity to talk about the markets, not just where we've been, but, we'll certainly start there as maybe the point of origin. But then we could pontificate on the destination, right? I mean, where are we
Exactly.
going? And that's always the fun part, to be a bit predictive. Sometimes we get into trouble, but we have a pretty good handle on how we believe things will shake out. So how do we get here? Well, it's pretty easy to think about why the markets have really run really strongly here. And that's this idea, real simply, that interest rates are no longer going up, right? The Fed back in July tightened for the last time in this cycle. And let's face it, weeks after July of 2023, we didn't know that was the last one. But then in September, the next meeting, when the Fed came out and said, we're not going to tighten in this meeting, then you said, okay, maybe there's some credence to July being the last one. And then the next meeting was November the 1st, right? The Wednesday after Halloween. And they again said, we're not going to tighten, and then so on and so forth. So as we moved away from that July last rate hike, it increasingly became likely, and the probability went up, that the Fed was done tightening rates. So that in and in itself is a really big deal, because let's not forget, back in 2022, when the audience, and thanks so much for tuning in, back in 22, when the market sold off 25%, the simple reason for that was rates were going up and we had no idea, right, how high those rates were going to go. So now we have a really clear idea that 5.5% is the Fed funds rate, right? The prime rate at your local bank is 8.5%, right? These are the high watermarks for this cycle. Now, no guarantee that those numbers can't go higher, but it seems highly improbable that they will. So that's the first point I would make. The second point I would make is, against that backdrop, right, that rates have hit a ceiling, we're starting to see I would say a large number of observations where the economy is actually getting stronger, right? Kind of interesting to think about that. But we haven't had a recession in 4 years, right? A diffuse recession where the entire economy fell apart. But we did have a set of rolling recessions, right?
Mhm.
Housing had a recession, 20% off the highs in terms of activity. We know manufacturing had a recession. We know inventories had a recession. We know lending had a recession. We know earnings for the corporate sector had a recession. And all of those, pretty amazing when you think about it, manufacturing just yesterday joining the party,
Yeah.
have bottomed and are inflecting higher. So we have a peak in interest rates. We have an economy that's reaccelerating. And most importantly, we have earnings that are expected to be up this year and next year against last year, where they were, slightly down. That's added a lot of fuel and accelerant to this market. And certainly the market is going up in anticipation of, better days ahead. And we could talk about, what interest rates do and whatnot. But that's the simplicity as to why this market has been up as handsomely as it's been in the past really 5 months.